The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to today's webinar. My name is Alex Voicu. I'm the Head of Education at PRMIA and your host for this session. The topic we'll address today is advanced structures and hybrid modeling, and I'd like to take this opportunity to thank FinCat for sponsoring the event today. Just a few basic housekeeping notes before we begin. The webinar will be recorded and shared with today's participants, and there will be some poll questions asked at the end of the session. We'll also have a Q&A period at the end of Jan's presentation. Just a few words about PRMIA. We're the Professional Risk Managers International Association and the meeting place for the financial risk profession, covering banking, asset management, insurance, and other corporations that have financial risk. It's my pleasure to be joined today by Jan Rosenzweig, who's the quantitative lead at FinCat, and has spent the best part of the last 15 years working in the financial markets as a quant, a trader, a structurer, a portfolio manager, and a fund manager. So he really has a complete perspective when he speaks to financial risk management. He's been working for Credit Suisse, Rabobank, HSH Nordbank, IV Capital, and Branch Roads. Currently, he leads the FinCat's professional service businesses in EMEA. Without further ado, Jan, the floor is yours.
Thanks very much, Alex. So to start us off on today's topic, I'll start us off with this quick cartoon. The theme of this cartoon is how to solve difficult problems and how sometimes these difficult problems may be not very easy to spot from the beginning. That is a feeling that should be pretty familiar to anybody who's worked in finance. Finance is full of these questions which are very, very easy to ask and yet next to impossible to answer. However, the good news is that in finance we do have some tools which can help us along the way. And during this webinar I'll try to identify a couple of these difficult issues, especially when it comes to modeling hybrids, and I'll try to discuss a handful of tools that we can use to make our lives easier. So before we start talking about hybrids, we should probably fix a definition of hybrids. So what we have here on the screen is one possible definition of a hybrid. So according to this definition, a hybrid would be a derivative or a security exposed to more than one asset class. Now that's a perfectly good definition. The problem is that this definition is probably a little bit too broad. This will include every hybrid we might want to think of. However, it will also include a number of instruments which are not necessarily hybrids or which most of us would not consider to be hybrid instruments. We can then move on to a more technical definition. So according to our second definition, a hybrid would be a derivative or security exposed to cross-asset correlation. That's a very useful test, and this is actually a test that I have used throughout my career to decide whether a particular instrument is a hybrid instrument or not. However, for purposes of this webinar, we will adopt a slightly broader definition. So here we will also include portfolios which are exposed to cross-asset correlations. So not just single instruments, but portfolios of instruments. And the reason for the inclusion will hopefully become clear as the webinar progresses. So where do we encounter hybrids? The first thing that comes to mind when we talk about hybrids are so-called traditional hybrids. So these will be instruments such as convertibles, reverse convertibles, warrants, etc. So these are typically instruments where the investor receives either equity or bond, depending on performance of one of them or both of them. Another area where we encounter hybrids is pension plans and life policies. So there are different types of instruments here: guaranteed minimum income bond, guaranteed minimum accrual bond, etc., which are all hybrid in character. Then there are so-called implicit hybrids. So these are typically long-dated notes, PRDCs, and the likes. So these are instruments which are not necessarily hybrids by design, However, they still have hybrid exposure. The next set of hybrids arises in project finance. So typically in project finance we will have some indexed income which we're trying to match to liabilities. And again, any optionality in that will generate hybrid type exposures. Then we have so-called regulatory hybrids. So these are typically CVA, DVA, BVA, etc. So these are not necessarily financial instruments. These are more risk numbers that require hybrid modeling. ALM hybrids, so these again arise from matching the asset portfolio to liabilities. ALM hybrids are on the whole not that dissimilar from project finance hybrids. However, the drivers are quite different. ALM hybrids tend to be a lot longer dated and they tend to be driven by liabilities, unlike project finance hybrids which tend to be driven by assets. The final topic I've put out here is OIS discounting. Not that OIS discounting is in itself hybrid in any way. However, under OIS discounting, everything behaves a little bit like a hybrid. As we shall see as the webinar progresses, the problems we need to solve when we're modeling hybrid instruments or hybrid portfolios are similar problems that we have to resolve when we're modeling something with OIS discounting. So this is a quick overview of the webinar today. I'll start by setting out some hybrid modeling challenges and discussing some ways to address those challenges. I'll then move on to discuss contract representation. So what's the best way to represent such contracts in some analytical framework? After that, I'll discuss analytical risk. I'll move on to a handful of examples, and finally this will bring me to our conclusions. So let's start with hybrid modeling challenges. So this graph shows a typical evolution of some observable market index. So a market index will typically have some forward curve, depicted here in light blue, and then the price of this index will be in some way dispersed around this forward. Now at the bottom, let's have a look at a slight modification of this picture. So now our forward curve itself is volatile, so the forwards are dispersed around the expected forwards. And then our index will be dispersed around this volatile forward as opposed to the fixed forward. The top picture is typical of instruments which are not hybrids. However, the bottom picture is typical of hybrids. And I would like you to keep those two pictures in mind when we move on through the next slides, because most of the difficulties that arise in modeling hybrids arise from the difference between those two graphs. What are our challenges when it comes to modeling hybrids? The first challenge comes when modeling forwards. If the underlying index is correlated with the curve used to forward it, then the simulated forward will be off. The correlation will generate some convexity of the forward, and we will have to adjust for this convexity. Now, if we were evolving these according to some simple textbook models, and the example I put up here is the standard textbook example of a log normal equity evolving with a Hull-White funding curve. Now, if you had such a simple pair of textbook models, then we might have some chance of working out what the convexity adjustment is in closed form. However, generally speaking, if we are looking at some realistic processes calibrated to realistic market data, chances are we will not be able to find a closed form convexity adjustment. The next set of issues arises when we talk about correlations in hybrid context. And the challenges here are more philosophical. The question here is, what is the actual meaning of correlations when we have different processes describing different underlyings? Let's say we take an example of an FX rate where the funding rate evolves in Hull-White and the underlying rate evolves in LIBOR market model, and the FX rate itself evolves in Heston. So now we have three very different processes, and we're trying to ascertain the correlations driving those processes. And the problem there is that there's not one set of correlations, but at least two. On one hand, we have the measured physical correlation between the actual indices that we're observing, and on the other hand, we have the input correlation between the stochastic factors driving these processes. Now, if all of these processes were in some way consistent with one another, if they were, say, the same process, then we could draw a straight line between those two correlations. However, in general, these two correlations, so the measured terminal correlation and the input serial correlation, do not even have to have the same sign. And there are multiple examples where, say, two indices could have negative correlation between the stochastic factors, and they will still move in unison, just because the forwards are driving them to move in unison. The final set of challenges arises from modeling volatilities. Now, the problem here is that the variance of our measured index will consist of at least two components. One component will be the variance of the price process around this volatile forward, and another component will be the variance of the forward itself. Now, there will typically be other components coming from correlation, but we can stick with those two for the time being. Now, the problem here is if we had calibrated the price process to option prices, vanilla option prices, and then we try to price those same vanilla options back using simulation, we won't get the same option prices back. In other words, our pricing will not round trip. Why? Because we will have only calibrated the actual price process and not the entire process consisting of the price process and of the forward. In other words, we have to find some way to correct for the variance of the forward. Which again, if these were simple textbook processes, we could hope to find a simple analytical closed form estimate of this variance that we need to correct for. But again, in general, for realistic processes, we should not expect that we'll be able to find that. So how do we address these problems? So now we'll talk about a class of hybrid models, so-called copula hybrid models, where there are some tools for addressing them. For example, when it comes to forwards, we can use something called automated numeric corrections. So the way numeric corrections work is as follows. We'll typically calculate the model implied forwards, so we'll simulate our index and we will work out what the implied forwards are coming from the simulation. On the other hand, we'll calculate the market forwards, so this is what we need to round trip to. We can form our convexity adjustment from, say, the ratio between those two numbers, and then we can scale all of our index price paths by this convexity adjustment. Now that sounds like a fairly simple process, and it is a fairly simple process. However, obviously, if you try to do that in reality, there will be some more complicated issues arising. However, as a process, it is a fairly straightforward way which is guaranteed to recover the forwards and to recover them exactly instead of approximately. In terms of correlations, we can use calibrated correlations. So what we're trying to do here is we're trying to recover our target physical correlations, so the measured correlations between the observable indices. And we can use the instantaneous correlations between stochastic factors as parameters to be calibrated. In other words, we can turn this into a calibration problem, where we're using the instantaneous correlation as correlation parameters, which we can drive in order to recover our target measured correlations. Now, that's good news because calibration problems are fairly straightforward to solve, and we do have an array of tools at hand that we can use to solve calibration problems. Finally, for volatilities, we can use volatility adjustments. So again, the target here is to price vanilla options to market. So what we can do here is we need to realize that the price process volatility is just one component of the variance, and we can use these price process volatilities as calibration parameters to recover vanilla option prices. So again, this becomes another calibration problem. And then depending on the framework that we're working in, we could solve these calibration problems sequentially, but we could also solve them all simultaneously. And then we would be running one multi-factor calibration instead of a series of one-factor calibrations. So that was a brief overview of hybrid modeling challenges. So now let's move on to contract representation. In order to represent hybrid and advanced contracts, we need a simple symbolic language for representing them. So the most basic component of such a language will be a single flow, and by that we mean flow of cash or physical assets, such as bonds or equities. One step up from that will be a leg. So a leg will typically consist of multiple flows, typically in the same direction, but not necessarily so. One step up from a leg will be a swap. So a swap will be some collection of offsetting legs, typically two offsetting legs. However, in general, there could be more than two legs, and they don't necessarily need to offset one another. Another component we need is choice. So choice is a right to receive either future flows or further rights. Then we have something called condition. So condition is not unlike choice, but in a condition it's not a right, but the decision on what happens will be made based on the situation of one of the indices. So the difference between choice and condition is the difference between, say, an American option and a knockout option. So in an American option, the option holder has a choice, so he needs to make a decision when to exercise the option. And in a barrier option, the option will knock in or knock out based on an objective test of the underlying observable. And finally, we need some convenience elements such as null flow, remainder flows, etc. There is actually a white paper describing this sort of architecture. It's called the optimal architecture, and at the bottom of the screen you should see the link to this white paper. So then how do we build this single flow? Well, a single flow will typically be an instruction to pay or receive a certain observable observed at a certain observation time. The payment should be made at a payment time, which will typically come after the observation time. That payment will be made against some notional, in some currency, and against some accrual fraction. And again, the details can be found in the white paper that's linked to in the link on the screen. So let's move on to our next topic, which is analytical risk. How can we calculate risk numbers and exposures for such products? Now, these products will typically be fairly complex, and most of the pricing will happen in Monte Carlo. There will typically not be any closed form prices available, and the dimensionality of the problem will be such that we cannot use backwards evolution type solvers. So we will typically be doing this in Monte Carlo. How can we recover our exposures in Monte Carlo? Well, the obvious answer is by bumping, as in we would run our Monte Carlo simulation, we would get the value, and then we would bump each and every market data parameter. We would see how the value will have changed in response to the bump, and that would give us the sensitivity of our value to that market data parameter. Now, that's a perfectly good method of calculating our exposures. however, it does suffer from some shortfalls. First of all, it's pretty slow. Monte Carlo simulations, if we want them to have any accuracy, will typically take some time. We will need to repeat the Monte Carlo simulation for every single bump, which will typically mean for every single market data point. And in any sort of realistic problem, we will have hundreds, if not thousands, of market data points. The second issue is that bumping is not particularly accurate. The Monte Carlo simulation itself will have a certain Monte Carlo error, and when we bump, we will be propagating this Monte Carlo error. First of all, we will need to ensure that our bump size is sufficiently large that it's not affected by the Monte Carlo error. But secondly, the error in the risk numbers will typically be at least an order of magnitude higher than the error in the value number. So we then move on to a technique called analytical risk. What is analytical risk? So in analytical risk, when we're simulating the value number, we're also simulating its first-order derivatives. And that, of course, assumes that we can calculate first-order derivatives either analytically or semi-analytically. We can then use the chain rule from calculus to propagate these sensitivities, and we can propagate them all the way down to market data points. And that way, in a single Monte Carlo run, we can recover all the sensitivities of our value number to every single market data element. One particular implementation of this analytical risk calculation is something called universal risk technology. So this is a technology which automatically calculates first-order partial derivatives using adjoint differentiation and without bumping. So it uses the method which I have just described, the propagation of first-order derivatives using the chain rule. Since it does that in a single Monte Carlo run, there is a small incremental computing cost. However, it is much, much smaller than what we would have to pay if we were just bumping every single market data point. The second advantage is that it is numerically a lot more stable. Typically, the Monte Carlo error resulting from adjoint differentiation will be roughly of the same order of magnitude in the risk numbers as it is in the value number. So the graph here shows curve exposures of one portfolio calculated in bumping and using URT. The light gray bars show exposures calculated using bumping, and black bars show exposures calculated using URT. Now, as you can see, these will typically be spot on unless there are errors, and when there are errors, typically we would rely more on the URT numbers than on the bumping numbers, because they will typically have been more accurate. In terms of the computational speed up, that really depends on the number of risk exposures we are calculating. However, typically these will be numbered in hundreds, and typically we will be looking at several orders of magnitude speed up in using analytical risk over bumping. So let's now move on to some examples. My first example comes from project finance, and where hybrid exposure arises in project finance. So in order to see our exposures, we first need to collect all the cash flows belonging in our project. So let's do that. So to begin with, our project will have a loan, and that loan will be drawn at some point. That same loan will have to be repaid at some point in the future. So here I have a very, very simple schedule of a single drawdown and a bullet repayment. Obviously, in reality, we might want to change that to, let's say, step-up drawdowns and amortizing repayments. However, in general, this is a good place to start. The loan will typically be funded throughout its life at something like LIBOR plus fixed spread or step-up spread or something like that. On the equity side, we'll typically have an equity injection, which will come in at the same time when the loan is first drawn. The project might go through a construction phase during which it is not generating any income. Then at one point the income will start, and finally when the loan comes for repayment, the value of the project will have to be realized in some way. So either the project will have to be solved in order to repay the loan, or the loan will have to be rolled against the project value. So no matter what method we use, we still need to realize the project value in some way. So we can probably firm some of this up a little bit. So we said that the loan funding costs are of the form of LIBOR plus spread. The income depends on the type of the project and the maturity of the project. It could be fixed, it could be inflation linked, and here I mean primarily commercial real estate projects and infrastructure projects. It could be linked to another index. So for example, in a commodity type project we might have the income linked to, say, some index of oil prices such as Brent. So we would typically have some market link or multiple market links describing to us how the overall market moves, and then we might have some idiosyncratic risk factors which will describe to us the specificities of this particular project and how it differs from the rest of the market. Finally, when it comes to realizing project value, again, we will have some proxy index or basket describing the overall market, and then some idiosyncratic risk factors describing how this particular project differs from the rest of the market. So these now are all the cash flows in our project SPV. And then the next step is to make our project defaultable. In other words, to give the equity holder an option to cancel the project and walk away from it. Now, if the equity holder exercises his option to cancel, he will lose his initial equity, he will lose his claim to any of the income of the project, and he will lose his claim on any component of the value of the project. However, he will no longer be liable to pay the funding on the project, and he will no longer be liable to repay the loan. So I will now show how we would model something like that in detail. So we'll take a very, very simplified example of a commercial real estate asset. The purchase price is 100 million euro. It is financed with a 90 million euro loan. The loan is 5-year bullet funded at 6-month Euribor plus 200 basis points. The rent starts at 10 million a year, and it increases annually linked to HICP-XT, the harmonized index of Eurozone consumer prices excluding tobacco. Finally, we need to pick a tracking index for resale value, and for this particular project we would pick EPRA Europe. So let's start putting this together. So the first component will be our loan funding leg. So this will start when the loan is first drawn. It will continue for 5 years until the maturity of the loan, and the schedule will follow 6 months Euribor. The actual rate that will be paid is 6 months Euribor, and the margin on that is 200 basis points. This will be paid on a notional of 90 million euro, and we as the equity holder will pay that. The next component will be the loan bullet repayment. So this will happen on the repayment date, and it will be 90 million euro fixed, and again this is something that we pay. So now we come to the first slightly structured leg, and this will be our income leg. So the income leg here we'll start it when the project starts. It will continue for the duration of the project, and here we have picked for all the rent to be paid annually. Now we didn't have to do that. We could have done that monthly or quarterly or semi-annually or according to any schedule that we wanted, But just for simplicity here, we just assume that the rent is paid once per annum. So what does that income look like? So we said the rent is linked to increases in HICP-XT. So here we have a component which is proportional to increases in HICP-XT, reflecting the contractual payments. However, here we've decided to subtract from that something called rent risk factor. So this relates to the possibility that our asset might deteriorate as time progresses, and the deterioration of the asset may result in us not being able to receive rent that was as high as was contractually agreed or as we might expect. Now, having said that, no matter what happens to the rent risk factor, it cannot drive rents to be negative. So here we have floored this at 0. We could have floored it at some finite number, or we could have floored it at some other index, but for the purposes of this example, we floored it at 0. So that now gives us the rent per unit, and then we'll multiply that by something called occupancy factor, which will tell us how many units are occupied at any point in time. So we said this rent starts from 10 million euro, and then it grows according to this floating rate index, which I have just described, and that is something that we are receiving. So this is the first example of a leg where we're mixing market factors and idiosyncratic project factors. So here we have a market factor, i.e. inflation, and we have two idiosyncratic project factors such as the occupancy factor and the rent risk factor. Now we obviously have to model these two factors as well. So let's pick one of them. Let's pick the occupancy factor. So we need to set some expectations and some volatilities of this occupancy factor. So this would be what that might look like. So we might start with a fairly low expected occupancy rate, say 40%. Then as time progresses and as we manage to sell more and more long-term leases, our expected occupancy rate will grow and it will peak at around 70%. Then finally, in the long run, as these long-term leases start expiring, we might see our expected occupancy factor to decrease, because by that point the asset will have been dated, and it might be difficult to sell further long-term leases. In terms of the volatility of the occupancy factor, that might start out high, reflecting the fact that initially we will not have sold too many long-term leases. Then as time progresses, the volatility would drop, reflecting the fact that now we have sold most of the asset in long-term leases. And finally, as these long-term leases start expiring, the volatility of the occupancy factor might pick up, reflecting the fact that we no longer have these long-term leases and we're not able to generate any more of them due to the age of the asset. And again, we might be back in the short-term leases, which would generate higher volatility. So the final component of our project will be the project resale value. So that will have to be realized on the same date when the loan is repaid, or just before that. And we said our resale value will be tracked by increases in EPRA, and then from that we will subtract another idiosyncratic factor, the sale risk factor, which will tell us how this particular project outperforms or underperforms EPRA. So this is multiplied by 100 million euro, and again, that is a component that we as an equity holder are receiving. So then we can take these four legs, our loan funding leg, the loan bullet repayment, the income leg, and the project sale, and we can put them into a portfolio, and that portfolio would now contain all the cash flows of our project. If we had any swaps, any forwards, any hedges, any offtake agreements for that project, we could put them into the same portfolio, and then they would also reflect the economics of our project, and they would do what they typically do, so reduce the volatility of the cash flows and reduce the volatility of the NPV of the project. So our final step would be to incorporate this option to default. So here we would turn this into a cancelable product. So we would give the equity holder cancellation option starting from when the loan is drawn, ending when the loan is repaid, and the cancellation rights would follow 6-month Euribor. Now the reason for that is that the only time when the equity holder might conceivably default is when he needs to make a payment, and the payments he's making in this particular model are the loan funding payments, which follow the 6-month Euribor. So therefore, the equity holder might only default according to that same schedule. Now here we've put 0 penalty for when he defaults, so in other words, he can just walk away from this with no penalty. And that now completes the modeling here. So now we've put together our project with default, containing all the cash flows, all the exposures, and the defaultability of the project. When it comes to pricing, we will price this using multi-factor cross-asset American Monte Carlo. American Monte Carlo because obviously we have this American or Bermudan cancelability on behalf of the equity holder, and cross-asset because, well, in this simple example, we have LIBORs, we have HICP-XT, and we have EPRA, which is an equity index. Plus, we have these project-specific factors which might follow any type of evolution that we might want to put into that. Now, if we have access to something called, to something analogous to the universal risk technology, we could use that to give us all the first-order exposures to all the market risk factors and all the project risk factors. And also we would use that to generate detailed cash flow reports, so both the contractual cash flows and the probability-weighted cash flows. Let's move on to my next example, which will be the guaranteed bonds. So the universe of guaranteed bonds is fairly extensive, and I'm not going to list all possible variations. I'll just go through some basic examples. So for example, there's the guaranteed minimum accrual bond, where the policyholder receives a single payment which is the greater of asset and cash. So typically the policyholder would start in some mixture of asset and cash. If the asset outperforms, then he will be moved out of cash and into the asset. And if the asset underperforms, he would be moved out of the asset and into cash. And finally, when the product matures, he would be left with the greater of asset and cash, and this would be paid to him as his benefit. Then we have the guaranteed minimum income bond. So now the same hedging strategy would be used to accrue his total pot. However, now he would receive some income on that pot rather than receiving it as a lump sum. So now he would typically receive some floating rate on this pot, and that floating rate will typically be floored. Now, depending on the contract, the policyholder might have a rollover option. In other words, he might have a series of choices whether to start his benefits or whether to remain in the product and continue accruing the benefit. And then we have various variations on this. So for example, we can look at rational policyholders who would always exercise these options optimally, and then we have to model that. On the other hand, we might just be looking at some policyholder behavior model where we have some model for the fraction of fund units remaining invested in the product. So what would a risk report look like for a product like that? So here's an example of one such product. So as we have said, the risk report will show the exposure to all of our product factors and market factors. So here, for example, we have modeled it using these cumulative survival probabilities, and as we can see the exposures to every single one of these cumulative survival probabilities. Then, scrolling a bit further down, we can see the exposure to various terminal correlations. So for example, here we have 6-month dollar LIBOR with 12-month yen LIBOR. We have yen LIBOR with the dollar yen exchange rate, etc., etc. Finally, if we scroll down, we can see our exposures to, say, implied volatilities of one of the stocks in the pot. Now, if we have a look through this, we can see that our Vegas peak at the 2-year point. Why is that? Well, because this product is fairly long dated, so we need to extrapolate our volatility surface, and the extrapolation will typically hang off the latest point in the vol surface. Right, my final example comes from the risk world, and that is CVA. So let me first go over the classical approach for CVA, so how we used to calculate CVA 5 years ago. So we would start by simulation of market evolution. In other words, we would generate market data paths. We would pass these market data paths through the definition of our product, through the pricing engine, through all the netting and collateral rules, and that would generate our exposure paths. The exposure paths would be aggregated to give us the full PFE profile, and from that we could infer the expected exposure profile. We would then pull out our default probabilities, so both the counterparty and the dealer default probabilities. We will discount our expected exposures by these default probabilities, and we would recover our CVA and DVA numbers. So that's what we used to do. Since then, we've evolved the so-called unified approach. So in the unified approach, we would start with the default probabilities, market data, trade data, netting rules, and collateral rules, and we would simulate all of them in the pricing engine. So in other words, we would simulate counterparty survival probabilities in unison with the market data evolution, and we would also simulate how that affects collateral posted after any netting. So once we've done that, we could directly get our CVA and DVA numbers from the pricing engine, and because of the way we're simulating this, we can now correlate counterparty default probabilities with our various market processes, and we can generate our exposure to wrong way risk. In other words, to the correlation between default probabilities and any of the market data elements. Again, if we were using an engine equipped with something like URT, we could generate analytical sensitivities, which would give us, on one hand, they would give us our hedge ratios, and then depending on how we set it up, we might use these analytical sensitivities to generate incremental CVA numbers and CVA allocation numbers. Now, the reason why I'm bringing this up in this context is that this is clearly a hybrid calculation. All right, so we've now come to the end of this webinar. We've gone over some of the hybrid modeling challenges and how to go over them. We've gone through a method for contract representation. We've gone over analytical risk, and we've shown a handful of examples. So what conclusion can we draw from this? Well, our main conclusion is that hybrid modeling is hard. However, we do have some tools that can help us. We have the numeric corrections used to help us with the forwards. We have calibrated correlations which help us make sense of hybrid correlations. We have calibrated volatilities which help us round trip all of our market data instruments, including options. We have analytical differentiation helping us recover all our risk exposures and all our risk numbers. And finally, we have languages that can help us put together such contracts and such exposures in some systematic way. So it is tempting to say that they all come together to make our hybrid modeling simple. That is not entirely the reality. Hybrid modeling is still hard no matter what we do and no matter what advances there are in the analytical technology. However, they do help. Thank you very much. We've come to the end of this seminar. Alex, it's over to you now.
Thank you very much, Jan. I'd like to take the opportunity to take a few survey questions here. We're going to start the first one. What hybrid modeling challenges are most significant at your firm? A, price reconciliation with counterparties. B, representing and replicating instrument payoffs. C, accuracy in valuation and profit calculation. D, correctly modeling correlations and volatility. Or E, none of the above. We'll keep the question open for another 30 seconds or so please check your answers. And our colleagues from FinCAD will provide you with the results at in a subsequent email, which will include the recording as well. Okay, we're going to the second question now. I'm going to read it out loud. What are some of the risk and valuation challenges you have seen related to hybrids? A, the granular level visibility into modeling assumptions, accuracy of risk and valuation calculations, computational challenges, or curve construction required for modeling hybrids. All right, we'll keep the survey open for another 20 seconds or so. Okay, and we're going back down to the third question and the last one. What type of hybrid modeling is most relevant to your institution? Asset liability management, exotic derivatives issuance, project finance, or CVA commutation? We're going to be closing the question in a few seconds now. And after that, I'm going to let Jan take some of your questions for the day. Okay, so Jan, I think we're done with the survey. Would you like to take a few of the questions from the audience?
Yeah, absolutely. So the questions can be submitted using the chat. We have a couple of questions here. One question is on the CVA and the difference between the two approaches to CVA. So specifically, is it worth going through such a complicated simulation method just to recover the CVA numbers? Well, the answer to that question is it really depends on what you're trying to do with the CVA numbers, right? I mean, if it's purely for reporting purposes, then no, probably it's not worth it. However, if it is for the purposes of offsetting risk, if it is for the purposes of, say, hedging or something like that, then chances are, yes, you probably do need to work out what your wrong way risk is, and you need to work out exactly how it affects your hedge ratios. All right, I think that's all the questions we have time for right now. We will be answering all the questions via email later on. Thank you very much, everybody.
Thank you, Jan, for your presentation, and we'll be looking forward to seeing you at future FinCAD webinars.
Thank you.